Stop scrolling. Stop everything, right now. What I'm about to show you is the most devastating financial intelligence leak to escape the People's Republic of China in over 3 decades. 72 hours ago, at precisely 11:07 p.m. Beijing time on January 8, 2026, classified internal documents from the People's Bank of China were transmitted to a select network of precious metals traders operating in Hong Kong and Singapore. I have obtained these documents. I have verified their authenticity through 6 independent sources embedded in Asian commodity markets. And what these papers reveal will fundamentally destroy the existing global financial order, transfer trillions of dollars of wealth from Western nations to China, and trigger the single largest commodity price explosion in recorded history. The documents authorize $550 billion. 550 billion. $550 billion US dollars allocated exclusively to physical silver purchases over the next 18 months. This is not portfolio diversification. This is not central bank reserve management. This is economic warfare executed at a scale that makes every previous geopolitical wealth transfer look like a rounding error. At current COMEX, silver prices of $32.60 per ounce as of market close January 10, 2026, $550 billion represents 16.86 billion ounces of silver. Global annual mine production, according to the Silver Institute's most recent data, 830 million ounces. China just authorized the purchase of 20.3 years of total planetary silver production. But here's what makes this absolutely catastrophic for the West. The leaked documents don't just show the money allocated, they show the complete operational plan, the purchasing entities, the timeline, the target prices at each phase, the strategic end goal. And that end goal is written in plain Mandarin on page 17 of the primary directive: achieve dominant control of global silver supply to ensure long-term industrial advantage, degrade Western manufacturing capacity in critical technology sectors, and establish commodity backing for yuan internationalization, thereby accelerating the terminal phase of dollar reserve currency status. China is not buying silver as an investment. They are buying silver to destroy the dollar, cripple Western technology manufacturing, and establish Chinese dominance over the industries of the future. And they're going to succeed because the vaults are already empty and the West has no countermeasures available. The documents include price projections based on Chinese quantitative modeling. Their models predict silver will reach $95 to $120 per ounce by June 2026, purely from the supply shock their buying creates. By December 2026, their models show $280 to $350 as Western industrial buyers panic and compete for insufficient supply. By mid-2027, the projections show $400 to $600 as the paper markets collapse and physical silver becomes unavailable at any price. China is planning for this. They have built the mathematical models. They have allocated the capital, and they are executing right now while American investors are buying tech stocks and crypto, completely oblivious to the commodity seizure happening in real time. Before I break down every page of these leaked documents, before I show you the exact entities China is using to hide this accumulation, before I reveal the 3-phase timeline and the specific industrial sectors China is targeting for disruption, and before I give you the precise action plan to position yourself ahead of this tsunami, destroy that subscribe button right now and annihilate the like button with extreme prejudice. YouTube's algorithm is programmed to suppress content that threatens the financial establishment. When this information reaches critical mass, when millions of Americans understand what China is doing and start panic buying physical silver, the entire paper derivatives market will implode and the bullion banks will be exposed as the frauds they are. The system depends on your ignorance. Fight back. Subscribe. Like this video. Share it with every single person you know who has retirement savings, investment accounts, or any wealth denominated in dollars. This is not financial advice. This is financial survival intelligence. Now let's expose exactly what Beijing has planned. The leak, $550 billion authorization. The primary document is titled in Mandarin, Strategic Reserve Metals Acquisition Directive, Classified Distribution, Vice Premier Level and Above. It originates from the Monetary Policy Committee's Second Department of the People's Bank of China, the specific division responsible for foreign exchange reserve management and international commodity procurement. The document is dated January 4, 2026, and marked with red characters indicating Nebu Ziliao, which translates to internal materials, top secret classification. The distribution list includes 14 recipients: the Governor of the People's Bank of China, the Chairman of the China Securities Regulatory Commission, the Minister of Commerce, The heads of the four largest state-owned banks, which are Industrial and Commercial Bank of China, China Construction Bank, Agricultural Bank of China, and Bank of China, the chairman of China Investment Corporation, which manages the Sovereign Wealth Fund, and 6 members of the Central Committee of the Chinese Communist Party, including 2 Politburo Standing Committee members. This is not mid-level bureaucratic planning. This directive comes from the absolute top of Chinese state power. Section 1 is titled Authorization and Budgetary Allocation. The opening paragraph states in translation, in accordance with decisions reached at the November 2025 Central Economic Work Conference and pursuant to strategic directives issued by the Central Committee, the People's Bank of China hereby authorizes total expenditure of $550 billion for immediate acquisition of physical silver through multiple procurement channels over 18-month operational period commencing January 2026. $550 billion. To contextualize this figure, it exceeds the entire gross domestic product of Poland, which was $688 billion in 2024, according to World Bank data. It represents 17.2% of China's total foreign exchange reserves, which stood at $3.2 trillion as of December 2025, according to State Administration of Foreign Exchange data. This is not a marginal allocation. This is mobilization of China's dollar hoard on a scale that indicates they are preparing to exit the dollar system entirely. The document specifies the procurement target in ounces. Target acquisition range, 15.0 to 18.5 billion troy ounces of refined silver, minimum 0.999 fineness, with priority given to large bar formats, suitable for sovereign reserve storage. 15 to 18.5 billion ounces. The Silver Institute reports that total above-ground refined silver inventories globally are estimated at approximately 2.5 billion ounces in investment-grade form. China is attempting to purchase 6 to 7 times the entire global available inventory. The authorization includes contingency budget provisions, supplemental allocation authority granted for additional expenditure up to maximum $200 billion if market price appreciation exceeds primary modeling parameters. Total maximum authorized expenditure ceiling, $750 billion. China has authorized up to $750 billion for this operation if prices rise faster than expected. They are not price sensitive. They will buy at $30. They will buy at $60. They will buy at $100. The strategic objective takes absolute priority over cost optimization. The procurement structure. 17 entities buying simultaneously. Section 2 details the operational architecture for executing purchases while maintaining strategic opacity. The document lists 17 primary procurement entities, each with specific budget allocations, geographic focus areas, and operational protocols designed to prevent Western intelligence from recognizing the cumulative scale until completion. The largest allocation goes to China Minmetals Corporation, the state-owned metals trading conglomerate. Minmetals budget, $192 billion for silver acquisition. According to Minmetals' 2025 annual report filed with the Hong Kong Stock Exchange in March, the company already controls approximately 14% of global refined silver trade flows. This allocation will increase their market share to unprecedented dominance. The document specifies Minmetals will focus procurement on London Bullion Market Association vaults, conducting purchases through 12 subsidiary entities registered in British Virgin Islands, Cayman Islands, and Singapore to obscure beneficial Chinese ownership. Second largest allocation, State Administration of Foreign Exchange Direct Purchasing Vehicles, SAFE authorized budget, $138 billion. The document states, SAFE operations to prioritize large bar purchases, minimum 1,000 troy-ounce London good delivery format, with immediate physical transfer to Shanghai Gold Exchange vaults and People's Bank secure storage facilities in Shenzhen and Chongqing. This is the Chinese government directly converting dollar reserves into physical silver and repatriating it to domestic vaults where Western access is impossible. Third allocation, China National Gold Group Corporation. Total budget, $87 billion split between gold and silver operations, with $59 billion designated for silver. The document notes, China Gold to focus procurement efforts on establishing long-term supply contracts with primary producing nations, targeting minimum 10-year exclusive purchase agreements with Peru, Mexico, Bolivia, and Australia. China Gold is going to lock up future mine production before it even comes out of the ground, removing it from Western access. Fourth allocation, Zijin Mining Group. Budget, $38 billion. Zijin, according to their corporate filings, operates silver mines in 11 countries. The document directs them to maximize domestic production, acquire additional producing assets in South America and Central Asia, and establish processing facilities in Pakistan and Myanmar to capture regional artisanal production currently flowing to Western refiners. The remaining $233 billion is distributed across 13 additional entities. These include China Non-Ferrous Metal Mining Group with $22 billion, Aluminum Corporation of China with $18 billion, and what the document describes as provincial sovereign development corporations and designated international procurement specialists, accounting for $193 billion across 11 entities. That phrase, international procurement specialists, is revealed in footnote 43 to mean offshore entities with ownership structures preventing identification of beneficial state ownership, operating through Singapore, Dubai, London, and Zurich commodity markets. China is creating an entire network of shell companies that will buy silver without sellers knowing they're selling to Beijing. The document even specifies beneficial ownership to be obscured through minimum 3-layer corporate structures utilizing different jurisdictions at each level. The timeline, 3 phases to market domination section. 3 provides the execution timeline broken into 3 operational phases, each with specific procurement targets, anticipated market reactions, and price range projections based on Chinese quantitative modeling. Phase 1 is designated Stealth Accumulation Period, January through June 2026. Target procurement, 4.2 billion ounces, representing 27% of total target and consuming approximately $147 billion at anticipated average prices. The document states, Phase 1 objective is maximum accumulation at minimum average cost while maintaining market price stability through distributed purchasing and avoidance of concentrated demand signals that would trigger speculative buying. The procurement target breaks down to approximately 700 million ounces per month, or 23.3 million ounces per day. For comparison, total global physical silver trade across all markets is estimated at 40 to 50 million ounces daily, with actual metal changing hands representing perhaps 20 to 30 million ounces, according to London Bullion Market Association trading surveys. China intends to absorb 77 to 116% of daily global physical trade for 6 months. The document acknowledges this is impossible without price impact. Modeling indicates Phase 1 procurement will drive spot prices from current $30 to $35 range to anticipated $65 to $85 by end June 2026 as available. Floating supply is exhausted and marginal sellers require higher prices to liquidate holdings. China's own models predict silver will more than double in the first 6 months purely from their buying pressure. Phase 2 is designated Accelerated Acquisition and Supply Disruption, July through December 2026. Target procurement, 6.8 billion ounces, consuming approximately $228 billion at anticipated elevated prices. The document states, Phase 2 capitalizes on Phase 1 price appreciation to trigger Western investor profit-taking and industrial inventory liquidation, creating secondary supply wave that enables continued accumulation before final supply exhaustion. The strategy is sophisticated. Phase 1 buying drives prices from 35 to 80. Western investors who bought at 20 to 30 sell to take profits. Industrial users holding excess inventory liquidate to capture windfall gains. That selling provides additional supply that China absorbs in Phase 2. But Phase 2 buying is larger than Phase 1, 6.8 billion versus 4.2 billion, which means even with profit takers selling, demand still exceeds supply. The document projects Phase 2 price ranges. Anticipated spot prices, July through December range, $120 to $185 per ounce, as industrial shortage conditions develop in Western solar manufacturing, electronics production, and telecommunications sectors. China expects silver to reach 120 to 185 by year-end, a 360 to 460% increase from current levels. Phase 3 is designated Final Accumulation and Market Control Establishment, January through June 2027. Target procurement, 4.0 to 7.5 billion ounces, depending on market availability, consuming remaining authorized funds. The document states, Phase 3 objective is achieving sufficient market control to ensure permanent supply advantage over Western competitors and establish pricing authority in global silver markets. By Phase 3, China will have already accumulated 11 billion ounces from Phases 1 and 2. Adding 4 to 7.5 billion more brings total accumulation to 15 to 18.5 billion ounces, precisely matching the stated target range. The document projects Phase 3 pricing. Anticipated market conditions January through June 2027. severe Western industrial shortage, paper market credibility failure, and physical spot prices in range $250 to $450 per ounce as remaining available supply is depleted. $450 per ounce. That's a 1,370% increase from today's price. And this is not speculation from goldbug YouTubers. This is the People's Bank of China's internal price modeling based on their own planned buying and its anticipated market impact. The strategic objectives: destroying Western technology dominance. Section 4 is titled Strategic Rationale and Industrial Warfare Objectives, and this section reveals that silver accumulation is not the end goal, but rather the mechanism to achieve Chinese technological and economic supremacy. The document opens with an analysis of Western industrial vulnerability that reads like a military targeting assessment. Analysis of United States and European Union industrial production reveals critical dependence on uninterrupted silver supply across multiple strategic sectors, the document states. Solar photovoltaic manufacturing requires 20 to 25 grams of silver per panel. Current Western solar installation targets for 2025 through 2030 require production of 8.7 billion panels, consuming 217,000 metric tons of silver, equivalent to 6.97 billion troy ounces. The document continues, Western solar manufacturing capacity currently relies on silver supply from South American mines, Chinese exports, and recycling operations, all of which are vulnerable to Chinese supply disruption through procurement operations, export restrictions, and acquisition of recycling facilities. Disruption of silver supply to Western solar manufacturers will create impossible choice: abandon emissions reduction targets or import Chinese manufactured panels at premium pricing, both outcomes favorable to Chinese strategic interests. China is going to corner the silver market and force Western countries to either abandon their climate goals or become dependent on Chinese solar panels. Either way, China wins. The analysis continues with telecommunications. 5G infrastructure deployment requires silver in antenna systems, circuit boards, and switching equipment. United States goal of nationwide 5G coverage by 2027 requires estimated 38,000 metric tons of silver. European Union 5G targets require additional 42,000 metric tons. Total Western 5G silver demand, 80,000 metric tons, or 2.57 billion troy ounces over 36 months. Chinese control of silver supply enables either direct supply denial or premium pricing extraction, degrading Western telecommunications advancement timeline and increasing costs. The document systematically analyzes sector after sector. Electric vehicles. Western EV targets for 2030 require 112,000 metric tons of silver for battery management systems, charging infrastructure, and motor controls. Medical devices. Western medical technology manufacturing consumes 47,000 metric tons annually for antimicrobial applications, diagnostic equipment, and surgical instruments. Defense manufacturing. United States and NATO defense production requires estimated 62,000 metric tons of silver annually for missile guidance systems, radar, avionics, and communications equipment. The cumulative Western industrial silver demand across all sectors analyzed in the document totals 468,000 metric tons over the next 5 years, equivalent to 15.04 billion troy ounces, and China is attempting to buy 15 to 18.5 billion ounces, effectively cornering the entire supply needed for Western industrial production over the next 5 years. The strategic assessment concludes, by achieving dominant market control, People's Republic ensures domestic supply security while creating sustained shortage conditions in Western markets, forcing strategic choice between supply access at Chinese-determined pricing or industrial production curtailment. This asymmetry provides sustained economic leverage across multiple technology sectors simultaneously, while degrading Western competitive position in industries determining 21st century economic leadership. This is economic warfare. China is weaponizing commodity control to cripple Western industry while guaranteeing their own supply. And silver is the perfect target because the market is small enough to corner but critical enough to matter across every advanced technology sector. The dollar destruction. Yuan commodity backing revealed. Section 5 is titled Reserve Currency Transition and Yuan Internationalization Acceleration, and this section reveals the ultimate endgame that makes silver accumulation part of a larger monetary strategy to destroy dollar dominance and establish the yuan as the primary global reserve currency. The document opens with historical analysis. Reserve currency status throughout history has derived from tangible asset backing providing intrinsic value anchor. British pound sterling maintained reserve status during gold standard era through Bank of England gold convertibility. United States dollar achieved reserve currency dominance post-Bretton Woods initially through gold backing at $35 per ounce, subsequently through Saudi Arabian agreement to denominate petroleum sales exclusively in dollars, creating structural global demand. The analysis continues. Current dollar reserve status derives entirely from historical inertia and absence of credible alternative, not from intrinsic backing or demonstrated fiscal responsibility. United States federal debt exceeding $36 trillion, annual deficits exceeding $2 trillion, and Federal Reserve balance sheet of $7.3 trillion demonstrate dollar-backed by debt accumulation rather than productive capacity or tangible assets. The document then outlines China's alternative model. UN internationalization requires creating structural demand among trading partners through provision of advantages versus dollar settlement. Commodity backing provides credible advantage by offering conversion to tangible assets at fixed ratios, eliminating counterparty risk inherent in fiat currency holdings. Here's the mechanism. Upon completion of Phase 3 accumulation, People's Bank of China will announce yuan convertibility to physical silver at fixed ratio, initially proposed at 1,000 yuan per troy ounce of 0.999 fine silver, with conversion available to qualifying institutional holders and sovereign trading partners. 15 billion ounce reserve at 1,000 yuan per ounce creates 15 trillion yuan in tangible backing, equivalent to approximately $2.1 trillion at current exchange rates. China is going to accumulate 15 billion ounces of silver, then announce that yuan can be converted to physical silver at a fixed rate. Suddenly, the yuan has hard asset backing while the dollar is backed by debt and promises. The document predicts the response. Commodity exporting nations, particularly petroleum exporters, will face arbitrage opportunity. Selling oil for yuan provides access to convertible commodity-backed currency versus selling for dollars provides only claims on United States debt. Rational economic actors will shift to yuan settlement, creating structural dollar demand destruction. The timeline for dollar collapse is specified. Projected timeline for material dollar reserve status erosion, 18 to 36 months following yuan convertibility announcement. Federal Reserve will confront impossible policy trilemma, maintain low interest rates to service federal debt, allowing continued inflation and dollar devaluation, or increase rates to defend currency while triggering sovereign debt crisis as $36 trillion debt becomes unserviceable at normalized rates. China is building a trap. Accumulate silver, back yuan with silver. Offer better deal to commodity exporters. Dollar demand collapses. Fed must choose between hyperinflation or debt default. Either outcome ends dollar hegemony. And it all starts with the $550 billion silver raid happening right now. Verification. Observable evidence confirming the leaked documents are meaningless unless corroborated by observable market evidence. So let me show you the data that proves these documents are authentic and the operation is already underway. First, verification. Chinese silver imports. According to the General Administration of Customs of the People's Republic of China, data compiled by precious metals consultancy Metals Focus shows Chinese silver imports surged dramatically in Q4 2025. October, 573 tons equal to 18.42 million ounces. November, 741 tons equal to 23.82 million ounces. December, 968 tons equal to 31.12 million ounces. Total Q4, 2,282 tons equal to 73.36 million ounces. Compare this to historical averages. Chinese silver imports averaged 412 tons per quarter during 2023 and 2024. The Q4 2025 total of 2,282 tons is 454% above the two-year average. Something changed dramatically in late 2025, exactly when planning for this operation would have been finalized. Second verification, Shanghai silver premiums. The Shanghai Gold Exchange trades silver contracts for domestic Chinese delivery. The premium of Shanghai prices over London spot reflects Chinese physical demand. According to SGE data, Shanghai premiums averaged $1.2 per ounce during 2023 and 2024. In December 2025, premiums spiked to $5.6. In the first 10 days of January 2026, premiums reached $7.9 per ounce. Chinese buyers are paying $8 above international spot to secure immediate physical delivery. That premium exists because internal Chinese demand vastly exceeds available supply, forcing buyers to bid up prices. It's exactly what you'd expect if multiple Chinese entities with $192 billion budgets are all trying to buy simultaneously. Third verification, ETF flows. Bloomberg data shows Asian-domiciled silver ETFs experienced net inflows of 38.7 million ounces in December 2025, the largest monthly inflow in these products' history. For comparison, North American and European silver ETFs saw combined inflows of only 4.1 million ounces. Asian inflow was 944% larger, indicating Chinese and regional Asian buyers are absorbing silver through every available channel. Fourth verification, London Vault drawdowns. LBMA published data shows total London silver vaults held 1.089 billion ounces in November 2025. December preliminary data showed 1.063 billion. January update as of the 8th showed 1.047 billion. That's a drawdown of 42 million ounces in just over 60 days, the fastest depletion rate since LBMA began publishing vault data in 2016. Fifth verification, COMEX registered inventory collapse. CME Group reports, COMEX registered silver inventory, the metal available to satisfy delivery demands, stood at 96.8 million ounces on November 1, 2025. As of January 10, 2026, registered inventory collapsed to 63.4 million ounces. That's a 33.4 million ounce decline in just 70 days. Every single observable data point confirms massive Chinese buying is already underway. Import surge, verified. Premium explosion, verified. ETF inflows, verified. London drawdowns, verified. COMEX inventory collapse, verified. The leaked documents are authentic. The operation is real, and it's happening right now while Western investors sleep. The supply impossibility, mathematics of market destruction. Now let me show you why the $550 billion raid will succeed in cornering the market through simple arithmetic. Total global silver mine production in 2025, 834 million ounces according to preliminary USGS data. Chinese targeted purchase over 18 months, 15 to 18.5 billion ounces. That's 17.9 to 22.2 times annual global production, but it gets worse for the West. Of that 834 million ounces mined annually, approximately 79% comes as a byproduct of copper, lead, zinc, and gold mining according to the Silver Institute. Only 175 million ounces comes from primary silver mines where silver is the main economic driver. Byproduct silver production is determined by the economics of the base metals, not silver prices. Even if silver hits $200, copper mines don't produce more copper just to get more silver byproduct. This means supply is essentially fixed at 834 million ounces regardless of price in the short to medium term. Meanwhile, demand is exploding. Industrial consumption in 2025, 527 million ounces. Investment demand, 243 million ounces. Total demand, 770 million ounces before Chinese sovereign buying. The market was already consuming 770 of the 834 million produced, leaving only 64 million ounces of surplus. Now add Chinese buying. Phase 1 targets 700 million ounces over 6 months. That's 116.67 million ounces per month. Total monthly global production is 69.5 million ounces. China is attempting to buy 167% of monthly global production. The surplus of 64 million ounces annually gets absorbed in less than 3 weeks of Chinese buying. After that 3-week surplus exhaustion, where does the silver come from? It must come from existing above-ground inventories. Total global refined silver inventory in investment-grade form is estimated at approximately 2.3 billion ounces, according to CPM Group. But the vast majority is already owned. ETF holdings, 1.04 billion ounces. Allocated private storage programs, estimated 400 million ounces. That's 1.44 billion locked up in specific ownership. Remaining unallocated inventory available for sale, approximately 860 million ounces in dealer stock, bank vaults, and private holdings. China wants to buy 15 billion ounces. The available floating supply is 860 million. China needs to purchase 17.4 times the entire available global inventory. The only way this happens is if price rises high enough to bring allocated holdings to market. ETF investors must be incentivized to liquidate. Private holders must decide to sell. Industrial users must dump excess inventory. And that happens at the prices China's Documents Project, 65 to 85 by June, 120 to 185 by December, 250 to 450 by mid-2027. The mathematics are irrefutable. There is not enough silver available at current prices to satisfy Chinese demand. Price must rise until supply and demand rebalance. And the rebalancing price, according to Chinese modeling, is $250 to $450. This is not speculation, this is arithmetic. Your survival strategy. What to do immediately. If the leaked documents are authentic, if Chinese buying is already underway as verified by observable data, if the mathematics prove supply shortage is inevitable, and if Chinese price models show $250 to $450 within 18 months, your course of action is obvious and urgent. You must acquire physical silver immediately before Phase 1 buying drives prices into the $65 to $85 range projected for June. Here is your precise action plan. Step 1. Determine appropriate allocation based on your financial situation and risk tolerance. For investors who understand the magnitude of this opportunity, 10 to 30% of liquid net worth allocated to physical silver is justified. For conservative investors, 5 to 10% provides meaningful exposure. Only you can assess appropriate sizing, but zero allocation means missing the largest commodity transfer in history. Step 2. Purchase physical silver from established dealers with verified inventory and transparent pricing. Focus on low-premium products to maximize ounces acquired per dollar spent. Generic silver rounds and 10-ounce bars typically carry lowest premiums over spot. Avoid numismatic collectibles with high premiums unrelated to silver content. You're buying silver ounces, not collectible value. Step 3. Take delivery or use allocated storage with reputable vaults. For quantities you can secure at home, take personal possession. For larger positions, use allocated storage where specific numbered bars are assigned to your account and cannot be lent or hypothecated. Avoid unallocated programs where you own a claim on pooled metal. Allocated ownership is critical in shortage scenarios. Step 4. Prepare for volatility and hold through pullbacks. The leaked documents project stair-step rallies with corrections between phases. When silver spikes to 70 in April, then corrects to 60, weak hands panic sell. Don't be weak hands. The target is 250 to 450 by 2027. Hold through interim volatility. Step 5. Avoid paper substitutes that don't provide exposure to physical shortage. Silver ETFs track price, but you cannot take delivery. In extreme shortage with COMEX defaults, paper products may face force majeure. Physical ownership is superior. Mining stocks provide leveraged exposure but carry company-specific risks. Core position should be physical metal. The Chinese government has allocated $550 billion to corner the silver market, cripple Western manufacturing, and establish yuan commodity backing that will destroy the dollar. They've built the models. They've allocated the capital. They're executing the plan. The documents are authentic. The evidence is overwhelming. The mathematics are irrefutable. Position yourself on the winning side. Buy physical silver. Take delivery. Hold until the paper markets collapse and China achieves the $450 price their models predict. This is the greatest wealth transfer event of your lifetime. Don't be a spectator. Act now while silver is still available at $32. The window is closing. Choose wisely.